Audio Jungle.
50% annual returns by the way of Warren Buffett. It was in 1999 that Warren Buffett, the greatest investor of all time, shocked the investing landscape throughout the globe by testifying that if he had $1 million to invest, he could guarantee 50% annual returns. Now you might be wondering about this statement because as far as the Indian stock market is concerned, the returns are somewhere around 8 to 10% annually, and losses are also common. So what's the common ground here? Well, today is your lucky day, because in this video, we are going to highlight some important aspects which will help you achieve 50% annual returns by the way of Warren Buffett. So in this video, you're gonna learn the secrets behind Warren Buffett's legendary investment career which enabled him to acquire 50% annual returns, which stocks to look for in order to generate returns greater than 30% annually, some quality stocks to watch out for in the Indian investing landscape, and how can you guys benefit from these growing companies. Human beings have a natural affection for the popular methods being employed out there, and the same is true in the investing world. Everyone gets attracted to some popular investing strategies, ignoring all the ground realities whatsoever. But Warren Buffett wants you to consider these crucial tips if you want to generate great returns on your investments in the future. Number 1. Look at quality businesses, not just stocks. Warren Buffett puts it that, when I buy a stock, I think of it in terms of buying a whole company, just as if I were buying a store down the street. This is what most investors in the Indian investing landscape overlook. They don't analyze businesses and don't even move a muscle trying to understand the business model. All they are reliant on is the brand model to outperform all other competitors. Let us just take an example over here. If you're buying a shop, you will analyze about the products dealt by the shop, overall sales, consistency of sales, competition for the shop, competition strength of the shop, how the shop will manage the change in customer trends, and so on. We need to apply a similar logic before choosing a stock. Don't think that you're only buying a few shares of that company. Will you buy the whole company if you had enough money? Adani Power is a power production company that has performed exceptionally well in the course of the last few years. It has a great business model that enables it to outperform all the competition in the industry, and hence it emerges as one of the best performing stocks in India. In the past 6 months, price of an Adani Power share rose from 123 rupees to 391 rupees, delivering 219% returns. Adani Power is one of the 7 listed companies of the Adani Group. The second best performer over half a year delivered less than 50% of Adani Power return. Adani Enterprises rose 109% during the same period. Similarly, when we look at Warren Buffett's career, he has always invested in quality businesses and has never taken a risk investing in junk or some fancy startup. Take the example of Coca-Cola stock. Buffett's company Berkshire Hathaway holds some 400 million shares of this stock, and Buffett has already termed it as a forever stock due to its incredible business model and its popularity throughout the world, hence emphasizing the importance of a good business model in investing. Number 2, are you willing to play long? If not, then don't expect even 20% of annual returns over time. Only buy something that you would be perfectly happy to hold if the market shut down for 10 years. In the short run, the market is like a voting machine, tallying up which firms are popular and unpopular. But in the long run, the market is like a weighing machine. Assessing the substance of a company, looking at the short-term opportunities in the stock market will not be a long-term successful strategy. If you don't feel comfortable owning something for 10 years, then don't own it even for 10 minutes. Let's just understand this with an example. Suppose you have savings worth 1 lakh rupees, and despite constant temptation for some luxury spending, you have finally resisted the feeling, and now you have decided to invest the money. If you invested that money in Britannia at 196 per share in 2010 and you stayed invested for 10 years, despite some macroeconomic conditions like political instability and some constant pressure from your peers to get out of the market, you still stayed invested. After 10 years, you will receive 1,940% returns due to the progress made by the stock. This is the power of long-term investing. So if the industry is expected to grow, the company in that sector with strong fundamentals will also prosper if all cards fall on the table. Similarly, another inspirational story that may help you consider the power of long-term investing is that of HFDC Bank. The financial sector has seen robust growth in the country with the penetration of banking. As banking grew and became formalized, banking stocks saw heavy inflows and grew exponentially. HDFC Bank was a part of this rally with an upward flow in its charts. Its revenues have moved from 16,314 crores in 2010 to 122,189 crores in 2020, a growth of about 25%. CAGR, while the stock has moved from 210 per share to 1385 per share, growing by about 660% over past 10 years, excluding dividends given by the company. These are examples of how a company grows gradually to generate strong returns for its shareholders, and as an investor, you must patiently be part of this entire rally, disregarding the smaller ups and downs. These examples go a long way in advocating for the efficiency of long-term investing. Number 3. Study hundreds of stocks before making a decision. Avoid investing in stocks based on popular opinions or useless advice by that neighbor of yours. Do your own research. Analyze thousands of stocks before choosing the right stock to invest. Once you have chosen a right stock, wait till the share is available at a very high bargain price. Buying a right stock at the right price is the key to investment success. Investors have the luxury of waiting for the fat pitch. Now, if you're looking to analyze some stocks to invest in for the long term, here is a list of stocks that can help you target those fat returns. Tata Metaliks. You know there's some gold in the company when you see the word Tata. However, this company is a subsidiary of the Tata Steel Limited, and it is actively engaged in the production and sales of ductile pipes and pig iron. The stock price of this company has gone up by 7% in the last 1 month. Currently, the stock price stands at 717 rupees per share, but this stock promises a lot in the long run. Bajaj Autos. Next in the lane, we have the Bajaj Autos. And if you've not already heard the name, which is actually highly unlikely, then you should know that there aren't many bigger players than the aforementioned company when it comes to two-wheeler and three-wheeler segments. And the astonishing fact is that they export their product to over 79 countries across the globe. Over the last 3 years, Bajaj Auto has grown earnings per share by 8.6% per year. That growth rate is fairly good, assuming the company can keep it up. HCL Technologies. The company ranks among the top 5 Indian IT companies and is a leading provider of technology and digitization solutions to global clients. Software-led IT solutions, remote infrastructure management, engineering and R&D, and BPO services are some of the services offered by HCL Technologies. So, if you're into some IT sector, then this stock should be a go-to stock for you. Number 4. BSE Sensex and NSE Nifty indices for big returns. If you're looking to target those big rates of returns annually, then you should have these indices at the barrel of your investing gun. Both of these indices have almost the same historical returns. The major difference between the Sensex and the Nifty is that the former is a measure of the performance of the top 30 Indian companies, while the latter tracks the top 50. Over the past 20 years, Nifty 50 TRI has given 14.18% CAGR returns. Over the same period, gold has 12.38% CAGR returns, while fixed deposits have given 7.1% average CAGR returns. Clearly, Nifty 50 has been relatively one of the best performing asset classes during this period, and similarly, the BSE Sensex has offered brilliant returns as well. If 5,000 rupees was invested as one time in bank FD in 2000, then it would have given us a return of 21,239 rupees by 2020. On the other hand, Sensex jumped from 5,000 to more than 41,000 in the same period of 20 years. That just shows how pertinent these indices can prove to be in an investor's journey in the Indian investing landscape. So that was all for today, folks. Make sure you keep these key aspects in your mind in order to compound your returns over the long period of time. So, do you guys want us to make a separate video on the two giant indices, Sensex and Nifty? If so, then let us know in the comment section below. Make sure you press the like and subscribe button, and we'll see you guys in the next video.